You recently sold a property for a solid profit, and the huge amount of money finally hit your bank account. It feels great until you realize the income tax department is waiting. Depending on your property and calculations, you could be staring at a tax bill of 12.5% or even 20%. For many, that means handing over lakhs of rupees. What if I told you there is a perfectly legal way to wipe out a huge chunk of that tax liability? You do not have to buy another house, and you do not have to lock your money into risky assets. The core issue is that most people only think about tax after the sale is finished. Panic sets in, and they rush into bad decisions, like buying a property they don't want just to save tax. Right now, for Indian investors, understanding Section 54 AC is absolutely critical. Property prices have surged significantly, meaning capital gains are larger than ever. If you simply leave that money sitting in a savings account, you lose a massive portion. Let us see exactly how capital gain bonds work and how they protect your profits. Let's break this down with real numbers. For the assessment year 2026 to 2027, rules around long-term capital gains tax on property have changed. You now generally face a flat tax rate of 12.5% without indexation. Suppose you bought a plot for 20 lakh rupees and sold it for 1 crore rupees. You have a massive capital gain. Even at 12.5%, you face a tax bill of 10 lakh rupees. That's 10 lakh rupees gone from your net proceeds, significantly reducing the cash you actually get to keep. Now here's where it gets interesting. Enter Section 54 EC. The core purpose here is to help taxpayers retain their profits while directing those funds into national infrastructure. Instead of paying that 10 lakh rupees as tax, the government allows you to invest your long-term capital gains into specified bonds. By doing this, the capital gain amount you invest becomes entirely tax-exempt. It's a simple mechanism. You earned a handsome profit, you lend that profit to the government by buying these bonds, and the government completely waives your tax liability. You keep your entire wealth fully intact and even earn steady interest on it. But who can actually use this? This exemption only applies to long-term capital gains from the sale of land, building, or both. It does not apply to shares, mutual funds, or gold. The property must have been held for more than 24 months. Absolutely any taxpayer can legally claim this, whether you're an individual, a Hindu undivided family, or a company. Non-resident Indians face certain compliance hurdles when investing in these bonds, so NRIs must carefully check their banking rules. Remember, it only covers long-term capital gains. Short-term gains cannot be exempted through this specific bond route. And this is the part most investors overlook. You do not have unlimited time. The exact time limit to invest in these bonds is strictly 6 months from the date of transfer of your property. That means the date the sale deed is registered. If you miss this window by even a single day, the exemption is gone and you must pay the tax. There are absolutely zero extensions allowed. Also, unlike other tax exemptions where you can park your money temporarily in a capital gains account scheme, Section 54 EC does not allow that. The investment must be physically made into the bonds within 6 months. So, where exactly is this money going? You can't just buy any bond. The government has a specific list of approved issuers. These include the Rural Electrification Corporation, the National Highways Authority of India, the Power Finance Corporation, the Indian Railway Finance Corporation, and HUDCO. These specific bonds currently offer an interest rate of around 5.25% per annum, payable annually directly to your bank account. Because these are backed by massive government enterprises, they carry a AAA credit rating, making them incredibly safe. They are straightforward fixed income instruments designed purely for capital preservation and effective tax saving. Let's talk about limits, because you can't park infinite money here. The maximum investment allowed under Section 54 EC is 50 lakh rupees per financial year. This 50 lakh limit is linked to your PAN number per transaction. You can't invest 50 lakh in March and another 50 lakh in April for the same property sale. If you invest the full 50 lakh at a 12.5% tax rate, you straightaway save 6,25,000 rupees. If your total capital gain is 80 lakh rupees, you protect 50 lakh. The remaining 30 lakh is taxable. Think of the calculation this way. If your long-term capital gain is 40 lakh rupees and you invest the entire 40 lakh rupees into these bonds, your tax liability becomes zero. Full investment equals full exemption. What if you only invest 20 lakh rupees? That's a partial investment. 20 lakh becomes tax-free and you pay the 12.5% tax on the remaining 20 lakh. If your gain is 70 lakh rupees, you cap the bond investment at 50 lakh, saving your tax there, and you pay tax on the exposed 20 lakh. Planning carefully saves money. But there's a catch. These bonds come with a mandatory lock-in period of 5 years. You can't touch this money for 60 months. During this lock-in period, you are strictly prohibited from selling the bonds, transferring them to someone else, or even pledging them to get a bank loan. If you try to take a loan against these bonds, the tax department considers it a violation. The consequence is harsh. The long-term capital gain that was previously exempted will immediately become taxable in the year you broke the rule. You must be absolutely sure you will not need this money for 5 years. The investment process is quite straightforward. You can apply directly through your bank, specialized bond brokers, or corporate fixed income platforms. You'll need your PAN card, identity documents, a cancelled check, and the property sale deed. Payment is usually made via check or real-time gross settlement. Once funds clear, the bonds are allotted. You can hold these bonds in physical form or directly in your DMAT account, though DMAT is safer. Finally, when filing your income tax return, you must explicitly declare the capital gain and claim the exemption by providing the specific bond details. It's helpful to compare this with other sections. Under Section 54, you invest in a residential house, not bonds. You have up to 3 years to build or buy, and the lock-in is 3 years. Under Section 54F, you sell any asset other than a house and must reinvest the entire net sales consideration into a residential house, again with a 3-year lock-in. Meanwhile, 54EC restricts you to specified bonds, has a strict 6-month deadline, limits you to 50 lakh rupees, and locks you in for 5 years. This section is best suited for investors who want a hassle-free passive way to save tax without the headache of finding and maintaining a new property. What this means is that careful timing is everything. The biggest mistake people make is waiting until tax filing season to think about this, only to realize their 6-month window has closed. The advantage of the bond route is sheer peace of mind. You get guaranteed capital safety, a modest annual interest payout, and massive upfront tax savings. This powerful option is perfectly suited for retirees, people downsizing their homes, or anyone who simply wants to diversify their wealth away from real estate into secure financial assets. Just remember to track your specific dates and don't exceed the limit. Everything we've covered today is purely for learning. Your financial decisions should be based on your own research and, if needed, guidance from a qualified advisor. If all this has helped you understand your property tax better, subscribe, drop your questions in the comments, and share this with anyone who just sold a property and needs to hear this. Thank you so much for tuning in to Paisa Forever today.